looking at 10 years there, it really looks like they were the most successful wealth destruction vehicles in healthcare, and that's pretty tough. I looked at the numbers. I was actually quite surprised at the numbers. The top three of the companies, Pfizer, Eli Lilly, and Merck, they all declined about 34, 35%. That is the total return. The decline in stock price was about 50%, but they do have a lot of dividends, so it wasn't as extreme. To compare, their benchmark is the S&P 500 health sector index. That was up about 20% total return. The price was basically flat. So you're looking at about 50% of an opportunity cost. If you invested in those stocks rather than in an index that covers those stocks, that's a 50% decline. If you invested in S&P 500, which covers many other sectors, the return was about 37%. So it was an incredible wealth destruction. And I think what David was talking about, their response to it, the large pharma companies, they grew so big, they started believing they could do everything. They could do everything from discovery through all phases of research, marketing, everything else. Well, clearly they can't. They are not doing it well. I think they deluded themselves that they could really do it. And what created these companies and created the excellence and made them the most admired, the most successful companies for many years was discovery. And I think they should be really going back to discovery. And I think that also creates a huge opportunity for CROs. And if you look at the returns for the CROs over the same 10-year period, there's quite a drastic difference. I look at the top of the companies, Covance about 340%, Charles River 70%, Icon 285%, Parexel 300%, PPDI 500%. The only company that actually has a negative return over that period of time is Campbell. And maybe not surprisingly, there were rumors last night that they might be up for sale. But the opportunity is incredible. And I think when I was thinking about it and talking to some of the people attending sessions yesterday, I think the CROs are selling themselves short. Their core competency is discovery, and I think they should go back to the labs and back to discovery and become, once again, the amazing companies, most admired companies in America that they were, and bring the resources of other experts to do the rest of it, to do the rest of the clinical development. I'm mixed about marketing. I think that's a complex issue.
Well, I guess my first observation is that when we talk about small pharma, I think we also include some big biotech, and they're run differently. They have had different ideas for developing drugs. Of course, they're focused on biologicals. So small, mid-sized pharma, kind of defining it, I think the way David did just a few slides ago, is like everybody except the top, 10, 20 big pharmas.
Right.
You think about that group, it's not a recent phenomenon that group has been getting more drugs approved by the FDA. I think you can go back, I want to say 10 years, and 3/4 of the drugs approved in any given year, virtually every year, have not come out of Merck, Pfizer, Bristol Myers, et cetera. They've come out of the Cephalons and the Amgens and the IDEX and lots of small, mid-sized companies. So I think those companies have demonstrated a success rate over a couple decades that's basically continuing. The fact that there are financial pressures on them means that there's a tight correlation between the availability of capital and the success or the fruits of the research that a lot of those companies do.
Okay.
And it's an unfortunate reality of life that I hear a lot of small company people kind of complain, not whine, but certainly say, when's it going to come back? When's the capital flow going to come back? The capital flow comes and goes. Investors come and go. But the engine of discovery, I think, Michael, is more in small emerging pharma. And I personally think it's going to stay that way. I think you see the companies run differently.
Over the last 20 years of history, CROs have enjoyed solid double-digit organic growth. I mean, in some cases, it's even been high teens or 20% growth. By organic, I mean internally generated, not acquisition. They've typically used acquisitions of some sort to, or specialized transactions to augment that growth and to respond to client service demands. We want you to add to what you do for us. With organic growth now much more challenging, I think, and maybe not more challenging than 2010, but if we stretch that out to a little longer period of time, I think organic growth over the next several years is going to be more challenging than it has over the last 5, let's say. We expect CROs will rely on some of these types of deals to more heavily to generate growth. Those deals fall into 3 categories. To make this easy to follow, we're going to talk about 3 categories. First of all, acquisitions by a financial buyer. Second, acquisitions by a strategic buyer. And then third, more acquisitions of client assets, or what we've been calling strategic deals, asset transfers. First, when I say client asset deals, I'm referring to facilities or people. So human capital could also be that asset that's transferred. The capital and critical mass required to absorb those assets restrict these deals to a short list, I think, of larger CROs, typically, though not always. The acquired labs or staff from a pharma client don't have an historical revenue stream or profit stream, so applying traditional valuations to these types of deals is obviously very challenging. There's no pricing, there's no bill rates, that kind of thing. That's all got to be established. The pharma's goal in these situations, in my opinion, is 1, to ensure stable and capable resources to complete anticipated development work. They want to make sure that they have the capacity to get done what they need to get done, but they no longer want to own it. B, reduce internal fixed costs. As I said, they don't want to own it anymore, but they definitely want to have access to it. C, create a soft landing for staff. I think there's a certain social, local employment factor to these things that still drives the decision. And D, negotiate lower unit costs. I think that's clearly part of what they're trying to do. On the CRO acquirers side, their goals, A, capture significant market share of the client's development spend as it is moving to outsource more. So just as they are making that decision, how do you put your net out and catch that business? B, negotiate inefficient selling and administrative costs out of the relationship. So what we continue to hear is that the RFP process either changes dramatically or no longer exists in these strategic deals, that the business, the pricing and a lot of the negotiation, the master service agreement happens up front. And then at that point, you know where the work is going and there's not a lot of RFP process after that. And then finally, in some cases, the buyer is gaining some novel service that can be cross-sold across additional clients or to additional clients. So to look at a few examples. Covance's Lilly, and later I've got a slide on the Sanofi deal as well. In those deals, the pharmas transition significant jobs to Covance in headline-sensitive geographies.
What is the newest thing is that sponsors are now willing to form strategic relationships, relinquishing control and actually benefiting through trusting each other. And then the large CROs are now looking for differentiated value add to extend and pull away from the mid-sized group. This is taking many forms, I would say. Some are focused on setting up vaccine franchises. Others are focused on their laboratory services as a key differentiator, and some information technology. And in my view, those that are focusing on biomarkers, biobanking, and really setting up for personalized medicine are ones that will be strategically aligned with the future of the pharmaceutical industry. And then as far as the environment itself, the CROs are still very focused on the large sponsors. I believe that there's more outsourcing that occurs than people realize. Phase 2 and 3 remains the largest outsourcing area, and most of the lab services are outsourced. To talk about outsourcing and strategic outsourcing and what that means, I want to spend just a couple seconds on it. To me, it really just is a commitment, and a long-term commitment based upon trust. And the amount of insight that you can give your vendor into the future, it allows them to do resource planning. Staff familiarity creates cohesion amongst both organizations, and really you end up with a better product. The responsibilities of the sponsor and the service providers should be clearly defined. The more integrated you are, the more cost savings you're going to be able to extract. And these are things like vendor search costs, transaction costs, relationship monitoring costs, and then also this issue of the transfer of obligation that is impacting the industry at the moment. That just needs to be resolved quickly. As far as standardized economics, I think the RPS model I've seen is probably the best that I've seen. But every clinical trial is really a simple function of activities.